I, Bhanvi, on behalf of IMPRI, Impact and Policy Research Institute, प्रभाव एवं नीति अनुसंधान संस्थान नई दिल्ली, extend my warmest welcome to you all to IMPRI Web Policy Talk. We are gathered here today for the IMPRI seventh annual series of thematic deliberations and analysis of Union Budget for the financial year 26-27. As part of this series, we will be engaging in a panel discussion on the Indian economy and Union Budget 2026-27. This discussion is organized by IMPRI, Center for the Study of Finance and Economics under IMPRI Web Policy Talk series. I warmly welcome all of you to this insightful deliberation and thank you for tuning in. The chair and moderator is Mr. Subhomoy Bhattacharjee, Consulting Editor, Business Standard, Professor of Practice, Director, Center for Regulatory Governance, Jindal Global Law School, OP Jindal, Global University, Sonipat. Today's expert panelists include Yuvika Singhal ji, co-founder and economist, Quantico Research India, Dr. Rajeswari Sengupta ji, Associate Professor of Economics, Indira Gandhi Institute of Development Research, Mumbai, Professor Pooja Misra ji, Professor, Economics and Area Chair, Economics and IB, Birla Institute of Management Technology, Dr. Sanjay Kathuria ji, Visiting Senior Fellow, Growth, Finance and Development Vertical, Center for Social and Economic Progress, Mr. TK Arun ji, Independent Journalist. The conveners of the program are Dr. Simi Mehta ji, Dr. Arjun Kumar ji. To begin today's discussion, I am honored to invite Mr. Subhomoy Bhattacharjee, Chair and Moderator, to share his opening remarks. We welcome you and over to you, sir.
Thank you, IMPRI, for having organized this session. In fact, it's one of the best things about IMPRI's this session is that it comes after people have had chance to catch their breath after one long breathless week in the Indian economy. And I think I think I would share everybody's opinion that in my long decades in watching and being part of the economic policy, I have never seen 1 week to encapsulate so much action on the policy front. In fact, when Arjun and I we were discussing some time ago about the dates for this seminar, and at the time we were sort of looking at Monday. And we sort of agreed that no, it will be better to catch the scholars out here on Saturday evening for their point of view, even though it sort of disturbs their Saturday evening schedule. One didn't realize that we were actually doing something wonderful. But the advantage from my position is, I'd rather wish to hear from all of you about not only the budget, but also what has happened. And I refer both to the India-European EU and the India-USA FTA and much else that has happened along with it. I think that we are in the right perspective zone probably to do that discussion. Just a couple of house rules or house suggestions. I suggest everybody goes in for the first 7 minutes for their points of view, and then after that we'll open the sequence for discussion. I think that will leave us with a considerable amount of time for us to have opinion on the subjects that have been raised. If that's fine with all of us, I suggest 7 minutes, and on webinar, the advantage is that a time can easily be flagged because for all of us to be there, obviously. So whether the budget was an event, was it a non-event, was it something that was just an accounting statement, or was it something that the economy really needed, or the finance minister sort of neatly sidestepped a difficult year by sort of passing the ball ahead. Ladies and gentlemen, the floor is yours. I think I understand Dr. Sengupta wants to go first. So Dr. Sengupta, the floor is yours, and we shall, as I said, we'll take about 7 minutes each So please go ahead.
Thank you so much, and thank you for inviting me to this panel discussion. I completely agree with you that the timing couldn't have been better, given that we have not only had the budget to process, and before we could even process that, we were getting one news after the other. I wanted to go first simply because I have to drop off at 8, unfortunately, for another meeting, so I didn't want to disturb others' schedule. So I have a small slideshow that I prepared, so let me just quickly share that. And I'll just use that as the anchor for talking about the main points that I have.
Dr.
So,
Sengupta, I'm just interjecting here just for a second. I should
sure.
have asked that initially. Any choice about who would want to go next after Dr. Sengupta? Dr. Kathuria, Dr. Misra, Dr. I mean, who would want to go? Or Arun, any suggestion?
I'm easy. Whatever you like, I can go next or whatever.
Okay.
Any,
So, Dr.
yeah.
Kathuria, the floor is yours. After that, I'll ask Dr. Misra, and Arun will have the last word. It's only fair that you sum up everybody's point of view. So, Yuvika, you go after that, and yeah. So, sure. Yeah, Dr. Sengupta, sorry.
Okay, so as I said, I'm just going to use my slideshow, hope it's visible to everyone, to just as an anchor for summarizing my points. So before I go into the budget, I want to quickly talk a little bit about what was the backdrop against which this budget was presented. And I am looking at it as of 1st February 2026, before we got to know about the US latest tariff changes, etc. And the EU deal had just happened. So, of course, it's just too soon to understand what the actual impact on the economy is going to be. Be that as it may, the backdrop from a domestic perspective is that, according to official data, the Indian economy is apparently growing at 7%. Now, I personally have done a lot of research on this, and I think there are serious measurement issues. So, it's kind of debatable whether the economy is indeed growing at 7%. But putting that aside, there are serious problems, most importantly on the jobs front, that I guess all of us would agree that there is an impending jobs crisis in India. When I look at the Consumer Pyramids Household Survey data from the CMIE, which is a little bit more strict in terms of its definitions compared to the government's PLFS data, but the general spirit of the message remains the same. What the CMI data shows us is that out of a total workforce of about 1,100 million people, which are greater than 15 years in age, as of 24-25, only around 456 million constitute the labor force, meaning that 456 million people are either employed or they're unemployed and looking for jobs. This number had been stagnant at 400 to 410 million for about 10 years. It's only recently in the post-COVID period that there has been some kind of a moderate expansion, but still the labor force participation rate in India is around 40-41%, as opposed to the global average of 60-65%, and China is on a bit of a higher end, which is 70%. When we look at the unemployment rate, the general unemployment rate is low, relatively speaking, it's around 8%, but in the 15 to 24-year age group, it is very stark. It's as high as 45%. In the 25 to 29-year age group, it's around 13%. And there was recently an ILO report which said that amongst the graduates, the unemployment rate is as high as 30%. So that shows the dire situation that the Indian job market is in, or the Indian employment scenario is in. Slightly looking at a sectoral perspective, given the unconventional and not really ideal structural transformation that Indian economy has had over the last 30 years, more than 40% of our workforce remains stuck in low productivity agriculture, whereas manufacturing, which ideally should have employed the vast majority of low skilled or unskilled labor, employs barely 25%. That share hasn't improved over the last 3 decades. Services, on the other hand, which is the dominating sector in our economy, employs more than 30%. But as we all understand, services sector is essentially employing skilled labor. And then over and above this formal sector kind of numbers, as we know, the informal sector employs close to 85 to 90% of workers. And that is a sign of the jobs crisis that I was referring to, that there is a serious lack of formal sector jobs in India, despite the fact that the economy is growing at 6 to 7% over the last several years. On the external front, again, this is something that we have been facing, particularly over the last 1 year. We are in the middle of unprecedented global economic uncertainty, particularly triggered by trade-related tensions and tariff wars. Between August and December 2025, this is when the US tariff of 50% started becoming quite binding on us. The merchandise exports grew by less than 1% on a year-on-year basis. Also, what has been happening that it seems India, the attractiveness of India as an investment destination for foreign investors is gradually fading. Capital inflows have been rather weak. Foreign portfolio investors last year alone have withdrawn close to $20 billion from the Indian equity market on a net basis. This is the highest withdrawal ever since data is recorded. Also, in terms of FDI, which is more longer term stable foreign investment, in a 22-month period between Jan 24 and October 25, India received close to zero net FDI in each month. And that is a combination of very low levels of gross FDI inflows, as well as high levels of FDI repatriation, and also Indian companies investing abroad. So the net result of all of this is that we have basically received zero net FDI in each month for a 22-month period. When I just look at gross FDI inflows, that has been stagnating at less than 2% of GDP for the last 4-5 years, in contrast to the mid 2000s when the economy was booming, when FDI to GDP ratio had gone up to 3%. And the combination of foreign portfolio investors withdrawing from the stock market, FDI inflows not coming in, despite this being a period of a China plus one strategy, where multinational companies are looking for alternative destinations, what has happened is that the Indian currency has depreciated by more than 5% last year against the US dollar, while the dollar itself was weakening. So 5%, it's actually effectively even more depreciation. So this is the backdrop against which the union budget got presented. As we all understand that the budget is not just a statement of government expense and revenues, it is, over the years, it has panned out to be some kind of a vision document that shows what the government is planning or thinking for the next year, for the foreseeable future. It is supposed to become a blueprint of economic policy for the short run. Now, viewed in that context, I have one main point to make when I look at this budget. In my reading of the budget, the biggest focus of this year's budget was an industrial policy, which was announced through a plethora of schemes across various industries, from textile to biopharma and also MSMEs, etc. Now, before I come into why I think that's a bit of a problematic approach, I want to give a bit of a background on what has been happening with multiple schemes that the government has announced over the last 1 or 2 budgets. In Budget 24-25, the government announced an employment-linked incentive scheme with an outlay of rupees 2 lakh crore, promising more than 4 crore jobs. This scheme finally became operational last year in August. Till date, there has not been any evidence of any job creation as a result of this scheme. In 24-25 budget, there was also an internship scheme that was announced, which promised 1 crore internships in 5-year period. Eventually, over a period of 1.5 years across 2 rounds, 1.65 lakh offers of internships were made by the private sector. Only about 31,000 joined. For more than 40% quit. Barely 100 job offers were eventually made. These are final job offers. The allocation for the scheme was
just a
slashed.
few minutes to wind up, please.
Yeah. Allocation was slashed by 95%. Then we had the production-linked incentive scheme, which, as we all know, 12% of the outlay has been disbursed till date. Majority has gone to Apple. We also had a skilling scheme in 23-24. The CAG audit shows that 95% of the details of candidates and bank accounts were either invalid or missing. So what I'm trying to say is that budget after budget, many schemes have been announced, but the performance and the monitoring of the schemes has not really yielded any favorable outcome. Now, when we come to this particular budget, I'll just take 2 more minutes. One problem of announcing schemes or industrial policy is that the government's or the policy makers' primary job is to create a favorable environment for the private sector to operate in. And I've listed like removing regulatory bottlenecks, simplifying taxation, enforcing rule of law, etc., as opposed to selecting, cherry picking industries and then deciding what the business should do, because that never really works well. And we have been through this journey already before in India. Secondly, what happens is when you do an industrial policy through schemes is that or through any means, in fact, is that India has weak state capacity. And we have seen many instances where state organizations are not operating effectively. Industrial policy is not necessarily a very good use of state capacity, which should be used in provision of public goods, which again don't really work very well to begin with in India. And the third point, is very important, is when there is an industrial policy signal that distorts the incentives of the private players and creates a certain nexus between the government and the private sector, because then production and investment end up becoming a function of bureaucratic connections, which in turn leads to corruption, etc., which again is not ideal given the backdrop that I was talking about. So a couple of miscellaneous points. Other than industrial policy, of course, there was a capex push, which has been used as a general growth generating measure over multiple budgets. This is welcome in this budget as well, given that there are problems in the economy. But is it successful in crowding in private investment? There is no evidence to show that. Also, the question arises, is capex push going to be sustainable? Given the fiscal constraint, most likely not. The fiscal math of the budget seems reasonable. However, this is the slowest fiscal consolidation since COVID budget. The primary deficit remains high. One measure of fiscal health of the government is the ratio of interest expense to revenue receipt. That is still very high. The gross market borrowing has gone up. That only leads to more financial repression. The budget talks about 80,000 crore disinvestment. It's not clear how that is going to happen because disinvestment targets have not been met in multiple other budgets. There's also a lot of reliance on dividend from RBI and public sector units. Again, that may not be sustainable. And more importantly, the promise seems to be that the debt to GDP ratio will go down to less than 50% in the next 4 years, but there is no medium-term fiscal strategy to achieve that. So this is my last slide. I would say that industrial policy being the center point of the budget, and I highlighted why I think that, in my opinion, is not only problematic, is not adequate to address the problems that the economy is currently facing. There were several other problems that could have been addressed in terms of a structural reform agenda or in terms of a near-term vision agenda, simplification of the tax regime, or trade liberalization, very important in context of all the deals that we are striking, not just on a bilateral basis, but in general, lowering tariffs, custom duties, and non-tariff barriers. The number of items on which custom duties were lowered in this budget is much lower than the last budget. And the average custom tariff rate continues to be high.
Dr. Sengupta,
I'm just going to conclude. So bilateral investment treaties, capital controls, all of these, in my opinion, were missed opportunities. So I would say there's nothing very remarkable or ambitious of the budget. At the same time, there is nothing too negative either. There were a lot of piecemeal announcements. But from my perspective, given the background that I was talking about, I think the strategy or plan for growth and job creation was largely absent. So I'm just going to stop here, and sorry for going over the time.
No, I'm sorry. I mean, it was quite engrossing, but unfortunately, we are slaves of schedules and things and all that.
Yes.
So I'm sorry for having rushed you along. I wouldn't get into the business of trying to summarize your excellent points. We'll have a chance to discuss those in the next round. Dr. Kathuria, the floor is yours.
Sure. Thank you very much, Dr. Bhattacharjee. And I agree with many of the points that Dr. Sengupta has made. I will draw on a recent op-ed that my colleague T.G. Srinivasan and I wrote in the print. I will make 6 broad points. First, I would characterize the budget as one of continuity, but with a lot of caution. And the jobs question being largely unaddressed, as Rajeswari also said, and I will focus a lot on that. The budget does prioritize stability, predictability. It's talking about a very volatile global environment. And so the policy has chosen to keep control over openness in particular. There is, of course, you asked about the India, the US, and the EU agreements, a framework in the case of the US. I believe they have reduced somewhat the volatility of the international environment, but they have certainly not eliminated it. It is going to be maybe not, on a 5x but it will certainly be in the range of 3x, 4x volatility in the international environment. So I don't think that's going away anywhere anytime soon. So my first takeaway is the steady budget which is focusing on global volatility. My second point is about the macro credibility aspect of the budget, where I think it does well. Keeps the fiscal discipline, although and the capital expenditure in particular going to its highest level in a decade at 4.4% of GDP. And the other positive point here in this budget is the reduced procedural complexity, especially on the customs side. But the caveat is, and I think that Rajeshwari also noted, is the overall public borrowing remains elevated. And of course, even though public investment is high, the growth impact depends on execution quality, right? So there is so that's my second point. My third point is that there is a proliferation of schemes, and the impact is very uncertain, right? So it's announced multiple new and extended schemes, including in manufacturing. Now, just to give you an example, the textile sector alone has PM Mitra, has the policy-linked, the production-linked incentive scheme, the new national fiber scheme. There is Samarth, which is for skilling. There's the sustainability and export facilitation schemes. So we can go on and on in each sector. There are huge risks in doing this. Who's monitoring all this? There is also a dilution of administrative focus, and eventually you cannot address structural problems through projects and programs, right? You have to eventually take hard policy decisions, right? So the effectiveness is and we have reasons. So effectiveness is not guaranteed, and based on past experience, past results, we have good reason to be quite skeptical about all of these schemes, right? So that's my third point. My fourth point is on exports, right? That export growth is now increasingly skewed, and this is in fact a direct result of policy focus, the way the policy. So if we've seen the recent export growth over the last few years, it's driven by capital-intensive production, engineering goods, electronics, pharmaceuticals, and services, right? So the engineering goods now as much as 27% of merchandise exports. Electronics have boomed. We all know that story of, especially on the cell phones exports, right? But the labor-intensive exports, so apparel and textiles have been stuck at 35 to 38 billion for the last 5 years. So so they're going down as a percentage of overall exports. Leather and footwear also stuck. And my argument is that skewing is not accidental, right? This is because of the way policies have been designed. There is the design of the PLI, there's the design of the tariff protection for final goods like steel, auto, consumer goods, and regulatory choices, right? So the labor-intensive sector faces higher input costs, weaker policy support, right? All of that. So my fourth point takeaway is that India's export winners in the last few years reflect policy choices and do not reflect India's comparative advantage. My fifth point is that why labor-intensive manufacturing is still struggling, right? So this is based. So we did a recent paper in CSEP with Priyanka Prabhakar and TG Srinivasan, where we talked about why Indian manufacturing continues to struggle. One is the input costs remaining a binding constraint. So MFN tariffs, for example, on man-made fibers are in the range of 5 to 20%, right? And as I said, there are these schemes that have been done domestically, but these do not substitute for globally competitive imported inputs, right? So that's the first sub point. Second one is regulatory barriers persist, right? So as Rajeshwari also said, there are 700 plus. So they've been, with much fanfare, 14 QCOs, quality control orders, were removed, but more than 700 still remain in force. And these are acting as non-tariff barriers, which particularly affect small scale and labor intensive sectors, right? The import reality is that the China is the dominant supplier of intermediates into India, right? South Korea and Japan also matter for some components, Germany for specialized machinery, right? So yes, I really welcome the EU and the US agreements, but these agreements will largely not affect input cost constraints, right? Because the way the comparative advantage is set up in the EU and the US, right? So they don't really do yeah. And there is an overall, sorry, you were saying something, Shubham?
Under 2 minutes.
Yeah, sure. I will do that. And yeah, and so basically there is this anti-export bias in our overall approach, where high domestic tariffs protect the home market, create an incentive, especially in all those sectors that I named, right? Autos, steels, a large variety of consumer goods, textiles, apparel, all of these, right? So you are really deliberately incentivizing the home market, and you're discouraging export orientation. So, the auto sector, we are, one of the largest producers in the world, but we export very little in terms of the automobiles. The sixth and final point I want to make is on jobs. This is why I want to come back to it, and the fact that jobs need scale, and scale is still being discouraged, right? So the labor market reality is that we are having 8 to 10 million people entering the labor force each year, right? We've had these labor codes, and a very good step in the right direction. They're improving predictability, they're raising thresholds, but the scale penalty is still there. It goes from 100 to 300, but it's still very much there. It's not been removed. World-class firms don't stop at 300 workers, right? So implementation also depends on the states, and it is a concurrent subject. So there is a lot of uncertainty in the implementation of these labor codes. The other constraint is access to land. Not much was done in recent years on that, including in the budget. So my point is that the market access was one of the issues in labor-intensive exports, but not the only issue, not the most dominant issue. The FTAs will help at the margin, but market access was never a binding constraint for us. We saw the 2017 China-US trade war. India got very little benefit out of that in the US market, which was penalizing China because of issues behind the border in our domestic market. So we didn't really take much advantage of the China-US trade war. So my closing thoughts are that the budget delivers resilience and focuses a lot on streamlining, which is great, and I welcome that. But without tackling these input costs, the scale disincentives, and the anti-export bias, we will probably see continued robust growth, but job creation will be lagging and will be insufficient to absorb new entrants. It's probably the biggest challenge facing India is to create more and better jobs. The EU and US agreements will open up the market. But is it enough to provide competition at home? Is it enough to provide industrials good quality inputs for the manufacturing sector? So my final line is the 3 C's: continuity, caution, but a big question mark on competitiveness. Thank you.
Thank you. I think that's a very succinct analysis of the budget, and but again, as I said, tendency to comment on issues becomes very proud. But I'll instead shift my attention to Dr. Pooja Misra. So, Dr. Pooja Misra, the floor is yours.
Okay, thank you so much. Thank you, IMPRI, first and foremost. And thank you for giving me the time to speak, Professor Subhomoy. Well, I would like to begin by describing, and we've heard this earlier also, that the budget is primarily a work in progress, capacity building budget, and the focus is on infrastructure development. And I totally agree with what Dr. Sengupta and Dr. Kathuria just mentioned about the employment-linked schemes, etc. But I would also want to draw everybody's attention to the fact that if we want to be a Viksit Bharat by 2047, we need to look at our urban areas. And they've certainly mentioned it in the budget also, where they've said it, in the long run, India is going to be an urban-led economy, right? And that's the point which I want to go back and focus on. We primarily need to move from infrastructure for movement to infrastructure for economic density. And why am I saying that? Yes, there is increased allocation of government capex at 12.2 lakh crore. So this clearly signals continued prioritization of infrastructure. Uh, and the important part is through a strategic focus on key sectors such as semiconductors, rare earths, biopharma, manufacturing, and supported by development of the seven high speed rail corridors, enhanced logistics connectivity. The government is working to put in place critical building blocks needed for India to emerge as a long-term player. Also, as far as the numbers go, the real GDP is expected to expand by approximately 7.4%. Inflation numbers are 2%. But we also need to keep in mind that these figures towards the mid of this month, towards the end of the month, might change. It might vary because once the new CPI and GDP calculations using the revised methodology comes into play. Like both of them mentioned, we are at a very critical inflection point in our reform trajectory. Yes, there are a whole lot of schemes being announced, but execution is important. Execution is key. And like I mentioned when I started talking, that the challenge is also particularly there, given that India's long-term growth trajectory is going to be increasingly urban-led. We're all very well aware that as far as cities are concerned, they account for approximately 60% of the GDP. They're emerging as the engines of economic growth. Yes, last year's budget did mention cities as growth hubs, creative redevelopment of cities, and it laid an important context for how urban policy has been evolving. But then India's rapid urbanization, obviously, it's at that inflection point where we need to reimagine our cities as well-planned, well-serviced, and productive economic hubs. We've already seen in the past week, 2 weeks also, the kind of services that we are getting from our municipal bodies, right? So, like I mentioned, as the nation aspires to become a Viksit Bharat, realizing the full potential of these agglomeration economies is what becomes very important, because that can go back and enhance urban productivity, reduce risk of urban diseconomies, and play a very critical role in avoiding the middle income trap. Right. So, yes, there's an urban challenge fund that was set up last year, 1 lakh crore, but we've all been reading that as far as this fund is concerned, as of now, nothing has really taken off. Yes, probably some states have gone back and put in requests for it, but nothing has really come out of it. This fund hopes to transform cities into growth hubs, but then has the execution started or not started? When I'm talking of cities, so cities spanning the length and breadth of the country require focused investment, and investment in urban transit systems, last mile logistics for individuals, because the last mile logistics will help bringing down even our pollution levels. And we've already had Geeta Gopinath talking of, as far as even pollution is concerned, it could be a major, major risk factor for the country. Plus, we need to go back. Yes, there was this entire discussion on smart cities. The program of smart cities took off, but whether the smart cities actually was a success story, not a success story, has somebody been looking at those numbers or not, is what needs to be checked again. So while I'm talking of cities as centers for job creation, it is important that between the union and the state budget, obviously the center and the state, we should be able to enable city-specific ecosystems which align with the local industry clusters. We should look at affordable, livable rental housing for our migrant workers and workforce mobility within these metropolitan regions also. A major reform push, which again everybody is very well aware of, is the municipal finance. Again, this budget does talk of incentivizing municipal bodies who can probably raise funds above 1,000 crores, of municipal bonds. If they can, then there will be an incentive that will be provided. But like we've all been saying, all these schemes, is execution happening, not happening? That's what the government needs to go back and look at and concentrate on. Enabling ecosystem is required, where these municipal bodies have access to predictable revenue streams, borrowing capacity, professional urban management, and first and foremost, they take responsibility for their own municipal areas per se. Another thought is property tax rationalization will go back and help. Growth potential of these cities can be fully realized through stronger, more empowered local governments. And that is another place where, again, the government is working on, but probably the momentum needs to catch up on that. When I'm talking of cities, urban climate adaptation is key. It must be supported through your dedicated urban climate funds, resilient infrastructure standards, incentives that promote compact, low carbon urban development. High growth will depend on cities functioning as an integrated economic system. Allocation of 5,000 crore for city economic region, which happened this time, it does set the groundwork, but without empowered cities and a coherent urban strategy, macroeconomic constraints will remain. So my key point here is that as cities emerge as growth hubs, and that's the direction that we're moving in, hopefully the execution will happen. Urbanization must be leveraged not only to generate jobs, but also to raise productivity per worker. And that's another factor that has been discussed even in the economic survey and has been brought to light even by the economic advisor. So one is where we're looking at GDP expansion. Second, simultaneously, to be able to be a Viksit Bharat, we need to increase our productivity levels, productivity per worker levels. Otherwise, technically, we'll again get caught, where the per capita income convergence will start slowing down in a little while, and it could result in us being caught in a middle income trap. So primarily, I will wind up here by saying that nation must make productivity and not just growth as the policy anchor. Treat our cities as economic systems, not just infrastructure projects, and invest decisively in human capital deepening, innovation, reform, urban governance, and finance. That's pretty much what I wanted to bring everybody's focus to, along with everything else that probably Dr. Sengupta and Dr. Kathuria mentioned.
Wow. You really have stuck to that sentiment absolutely correctly, which doesn't mean the others haven't, but it always is delightful. There's a lot that is coming up for discussion. But before that, let me bring in Yuvika Singhal for her comments. The floor is yours.
Thank you. Thank you, IMPRI, for inviting me to this panel discussion. And it's always difficult to go last after such illustrious speakers because a lot of ground has been covered and I really have to think through what I want to talk about. But I think let me highlight a couple of points. I may be sounding repetitive, like I said, after 3-4 of the panelists who have already given their overview of the budget. But I think the biggest takeaway of this budget for me was it was a budget for continuity and for long haul. It was a budget which looked beyond one single year, and probably that was the need of the hour, largely because the global economic environment, the global trade order has shifted very dramatically. And I think it made sense for the government to not undertake any kind of adventurism in the budget and stick to the basics that would have probably not unsettled either market participants or any of the economic stakeholders. So for me, it was more like business as usual and probably keeping a watch on the evolving developments from the government side. If you look at the fiscal arithmetic, for me, the biggest positive was that the finance minister stuck to the fiscal consolidation path. And this budget did take forward that pivot that the finance minister had promised previously, that from going forward, they will now want to direct the debt to GDP ratio lower to 50% plus minus 1%. And that's the target that they have set out for FY31. Keeping that objective in mind, the budget announced, as we all know, just 50 basis points of correction in that debt to GDP ratio, from about 56.1 to 55.6, which translated into just 10 basis points of correction on the fiscal deficit. Now, this to us was somewhat on the conservative side, and we thought that the government could have probably gone a little more aggressive, both on the debt to GDP ratio as well as the fiscal deficit ratio, largely because, the market participants were somewhere the consensus was somewhere that, 4.2% of fiscal deficit could be seen. So it wouldn't have been a surprise had they announced a lower fiscal deficit. But more importantly, remember that the government is looking at a big chunky revenue expenditure from FY28, which is going to come from the 8th pay commission. So that is going to likely upset government's fiscal maths in FY 28 and 29, and those years would probably be very difficult for the government to consolidate. They'll really have to think out of the box to get adequate revenues to finance probably 2 to 2.5 trillion rupees of the 8th pay commission estimates, that we are working with at this point in time. So a little bit more aggression this year would not have hurt anybody. First. Second, I would also, then we could also probably flip the argument and say just 10 basis points of fiscal consolidation probably gives a little bit of edge to the government to support growth. There's always a trade-off between fiscal consolidation and supporting growth. So maybe the government was a little conscious, but okay, they're wanting to support growth. But that didn't spell out very well for the bond market. So if you look at the pace of consolidation and the total amount of government bonds supply that is expected to hit the market, that's a huge number. In gross issuances, it's almost higher than 17 trillion. And if you put together the state development loans and some of the borrowings that will be done by the public sector enterprises, we are staring at a huge supply of bonds this year, upwards of 31 trillion. And how the market is going to clear is something that is, making the investors extremely jittery. Now, remember, even last year, the RBI had to step in to undertake OMOs, and that did support the market. But this year, the supply is going to be even higher than last year. And SDL borrowings have been on accelerated path. And how do you put together this supply at a time when most of your demand, the buyers of bonds, whether it's RBI, whether it's bank, PF, financial insurance companies, they are not really looking at adding big chunk to their demand. So how do we go about this? So there is a little bit of out-of-box thinking that policymakers need to do, whether they need to announce, a sizable degree of debt buybacks and give markets some clarity as to how that will happen, do probably operation twist as we have seen in the past, and probably some bit of regulatory nudge to the demand players in the system, such as the PF companies, the insurance, the banks, as to how to allocate these bonds, that huge supply that is expected to hit the market in FY 27. How do we make sure that the demand and supply balances? And this is somewhat lacking when we look at the monetary transmission as well. So despite RBI having cut by almost 125 basis points in the last 1 year, we haven't really seen the 10-year GSEC yield move. We have not seen it correct to any extent for that matter. It's been fairly at the same levels where it was a year ago. So monetary transmission to translate in a much more meaningful way, the government and the RBI need to think a little bit more pragmatically that how this is going to happen. Probably from a policy perspective, one point that I would want to leave the audience with, which was not touched upon by any of the other speakers, was the focus of the budget on the services sector, not just the traditional services sector of health, education, tourism, where we saw a lot of policy focus, a lot of micro announcements as well, but the focus on new age services, AI, global capability centers, data centers, and that is where the future of the country is in terms of proceeding towards the Viksit Bharat goal by 2047. Focus on industrial policy is good, but services, remember, comprises a bulk of our GDP. It has the potential to create jobs if adequately given the correct nudge. And remember, for the month of December, it's probably the first time that services exports are actually higher than merchandise goods exports at more than 40 billion. This is for the month of December. And this is going to be a structural story maybe for the next years to come. And the pivot is clearly being seen in the month of December. So the focus on services and the multiplier that the services can generate, I personally feel is somewhat underestimated. But the budget beautifully brought out the focus on GCCs, data centers. They provided a long 20-year tax holiday to a company who would come in and set a data center in the country. In turn, probably giving some incentive for FDI also to build in the sector. So it's a long-term strategy that the government is trying to play as far as the services sector is concerned. They also announced a high power committee. And when we talk about a high power committee, it's somewhat more, it has longevity to it. And the role of the committee essentially is to announce reforms to build services capacity in the country. So clearly, the budget did touch upon certain areas of growth. It did talk about high-tech manufacturing services, and that to us aligns with the Viksit Bharat goal of the government. And sometimes, it's easy to say what the government did not do. But like I said at the beginning, the budget is probably, one of the exercises through which the government indicates its intent of policy building. We have seen it in the last few years, and that's become the hallmark of this government, that a lot happens outside the budget as well. You look at any of the reforms that have happened in the last couple of years, whether it's labor codes, whether it's the GST restructuring, a lot of reforms have actually happened outside the budget. So they need not wait for the budget, or they need not incorporate everything that they are working on in the budget. Budget is more of an intent, a policy document, which reflects the work in progress of the government. And I think that's how I would perceive it. In my closing remarks, I would probably say that sometimes stability works as the cheapest subsidy a government can give. And I think this budget is a good depiction of stability and credibility, both in terms of the policy announcements as well as the budget arithmetic that the finance minister put forth. I'll stop here. Thank you so much.
Thank you very much. In fact, I was looking forward to a wide range of views, and that's just what has happened from the first initial set of remarks. I must also, right at this point, thank every panelist for having stuck to the time, because that has opened up a wonderful chunk of time for us to, look at specific issues. So that's great. Let me first, one of the issues that came up, and rightly would come up, was the issue of employment. That is something almost all of you touched that. Let me start by asking Dr. Sengupta, you made a very strong statement that there's no strategy for growth. And also, yet you were also saying that it was reminiscent of the central planning of the earlier years. I was sort of trying to think that whether that planning stage had resulted in a good yield on employment. But definitely the fact that we are under hitting the mark on employment growth rate is something that we need to think about. So would you like to go on a bit on what would you say, supposing if there was central planning or what would you say that should be a strategy that the government should be looking at? So should it be multi-year, or what would you say would be coming along? I'll come to Dr. Kathuria also somewhat on the same issue, but yeah.
Sure, absolutely. Thank you so much for the question. It's a very, very interesting question. So to answer, I would sort of take on a little bit on what Dr. Kathuria also mentioned, that, there is something called a demographic dividend that the Indian economy is enjoying more than most countries of the world, which is great. It's like we have a limited window of about 20-25 years to make the most of this demographic dividend that almost no other country, barring the sub-Saharan African countries, no other country enjoys, right? And this is our opportunity to create jobs for all the 10 million young people who are entering the workforce every year. And then that in turn generates consumption demand, which in turn triggers investment demand. And then we are able to sustain an 8 to 9% GDP growth for the next 20 years, which is only when we will be able to do Viksit Bharat by 2047. Anything short of that, at 6%, we are not becoming Viksit Bharat by 2047, right? When I said there is no strategy for growth in jobs, that's what I meant. That budget after budget, we are seeing projects, we are seeing schemes. Services sector, yes, sure, but services sector employs very, very few of those 10 million people who are entering into the workforce. The GCCs are employing 80% of the tech jobs, but the GCC employment is less than 2 million. So the services sector being 60% of India's GDP is basically what has helped us grow at 6 to 7%. But that is why we are also getting a jobless growth. So yes, the services sector will have to continue to grow to give us that kind of 6-7%. But ultimately, if you're not creating jobs, somewhere it's going to peter down because consumption demand is slowing down already. So I think exactly what Dr. Kathuria had said, we needed budget after budget, enough signal or strategy to show that the government is serious about creating labor intensive or jobs in the labor intensive industries, right? And again, I don't really believe that it's the government's job directly to do industrial policy and create jobs. The government's job is to create an environment where the private sector can come in and start investing and creating the jobs. And that hasn't happened for the last several years. Private sector investment has remained sluggish for several years, barring that immediate post-COVID increase that we had seen. Why is the private sector not investing? That's the question that we need to ask. The government is doing capex push, which is great. I commend it. But why is that not crowding in private investment? Why is the private sector, why is FDI not happening? In a world where there is a China plus one strategy, when multinational companies are looking for alternative opportunities, which India should have been one with its very large population and consumption force, why is that our FDI is falling at a time when other companies are looking for alternative destinations? So something has gone wrong in the overall policy structure, in the overall policy framework. That is something that needed to be fixed budget after budget, which is about opening up the economy in a massive way, not just doing bilateral trade deals. Bilateral trade deal is something that has happened in the Vietnams of the world 10 years ago. We are doing it only now. We need to do a lot more. We need to lower QCOs. We need to lower non-tariff barriers. We need to lower customs duties. We need to create a level playing field for all our players in the market, not just for the Apple or the national champions that keep getting the favors. We need to create a situation where the regulatory barriers are not so costly for firms to do business in. So year after year, the ease of doing business in India has actually worsened. That is something that the government, I think, should have addressed, not do picking of particular industry or not do schemes in a particular industry, because you can't scale that up. You can't continue after 1 year. That's not going to create millions of jobs. That's not going to create investment. It hasn't happened. This government has been trying schemes and projects for the last 9 years. That hasn't happened. Something else needed to be done. I was a bit disappointed because I saw exactly that same spirit of schemes and projects and piecemeal announcements and 1 lakh crore and 2 lakh crore of allocations, which never get monitored. We don't really see the outcomes. They don't really seem that worried about the jobs problem. That was my concern. And if you're not worried about it now, once the demographic dividend starts turning, it's a one-way irreversible process. There is no way we can do anything at that point of time. I feel we are losing precious time. So I'm looking at a very macro, very long-term perspective, and I'm adding up all the 9 budgets. I don't see that strategy for growth and job creation from this government. That's basically what I meant.
That's beautifully enunciated. In fact, it's also the right forum for you to make that point, because IMPRI, there's a lot of young listeners who are coming in, and for them, one of the major issues that comes along in today's world, in any world at the time, is the issue of jobs. And in that context, I want to turn to Dr. Sanjay Kathuria. So one of the things that I had always thought was, there was this sudden comment, and I refer to the study that you did at CSFE, and I wonder whether you had a chance to look at it. There was this comment on SEZs after a very long time in the budget, to enhance capacity utilization, economies of scale, and export-oriented investments. Forgetting the fact that SEZ was something that I had looked at very carefully at one stage, and I was sort of thinking that that was one of the interesting stuff that Dr. Manmohan Singh's government had tried at the time. Dr. Kathuria, I mean, Dr. Sengupta is talking about the fact that there's lots to being said, but there's the missing point, which she's saying is not, I mean, there's something missing in the budget, arithmetic in the budget policies and the budget strategies, which doesn't add up to an employment multiplier. I mean, how do you look at it? And you in fact, you talked about the fact that exports can be a very major multiplier and for a labor intensive economy.
Thank you. Yeah. Thank you. And yeah, I very much agree with what Rajeswari has said. First, a quick diversion on the SEZ's point that you raised. I did look at something that they will permit one-off basis exports into the domestic tariff area, basically sales. SEZs are separated. They are an enclave, but they will permit I guess for demand reasons or whatever, for one-off exports into the DTA, domestic tariff area. But that's not really a sort of policy statement. I think it's just a one-off thing. I haven't seen anything else. There's a lot to absorb in the fine print. But let me now go back to the bigger question of growth without jobs. I think that is in some sense the biggest challenge facing the Indian economy. So let's see what can external demand do, right? So when the Asian economies were growing, East Asian tigers, so-called, external demand was a massive underpinning of those economies. Now let's look at India, right? So I would say that doing our growth, the growth job correctly, and also fixing the employment part, we can use external demand to underpin maybe even 1 percentage point to 1.5 percentage points of additional growth that we can get. I think that we shortchange ourselves on that front. Look at we do say we're a very huge middle class, right? But when you actually come down to the numbers, you start seeing that it's actually the kind of demand that exists for more and more expensive, especially when you call FMCGs, fast-moving consumer goods, then you come against demand bottlenecks very quickly, right? Now, Apple tells me, for example, that all their incremental production is now going into exports, right? There is nothing. They're more or less bottomed out or saturated for the moment. It'll be only incremental annual growth on the domestic side. So there are constraints to what domestic demand can provide you. The additional kicker for external demand is that it is in line with comparative advantage. So our comparative advantage should be in labor-intensive production, notwithstanding the success of services and GCCs. And as Rajeswari said, these are very small in terms of employment numbers, right? So external demand, if we allow it, it will be for labor-intensive production because that's where our strength should be, right? So if you look at the poverty numbers, right, which is in some sense another way of looking at demand constraints, right? Let's go beyond the poverty lines, right? Poverty lines are bare bone. But if you start looking at upper middle income poverty line, or the Viksit Bharat poverty line, which is the crossing the developed country or the upper middle income, the higher income thresholds, then we're talking of poverty rates which are more than half the economy, right? Because your standards then are much higher. Your so-called poverty lines are much higher. Therefore, we do have to realize that there is no getting away from external demand to provide that additional impetus to growth. The good thing about external demand is that it can also be labor intensive, provided we fix our incentive structures in the way that I spoke about, and Rajeswari also talked about in many ways. Therefore, to do that, I do get to in some sense, the biggest underlying gap in India of our ability to really take advantage of the external market, apart from all the policy shocks on the trade side, the policy concerns on the trade side, urbanization, access to land, all of that, what Pooja also spoke about. But I think the biggest, in some sense, the long-term issue for India is the quality of health and education services, our ability for our people to participate. That comes in the health, right? If you're going to be off the workforce for so many days in a year, that's not effective. Second part is the quality of education. I mean, we all know that, right? The probe research reports tell us year after year. Now, it is abysmal, and that is, in some sense, it's the long-term issue. Right now, we have a stock of people waiting to join. There are the underemployed. The women labor force participation is very low. So for the moment, for the next 5 to 10 years, we can draw on the stock of unemployed and underemployed. But for the long term, for sustainability, for prosperity, for inclusive growth, there is no getting away from improving health and education, and also, of course, bringing far more women into the labor force. We're stuck at, I mean, I know there's lots of debate about numbers, but whatever the number you expect on women's labor force participation, it is half. You say 20%, 30%, whatever number you take. But you look at China, look at East Asia, we're talking in the 60%, right? They're almost equal to that of the men, right? And there's a huge gap in India between male labor force participation and female labor force participation. So I think these are really long-term issues that we need to take about. And my final long-term issue is technology. Some colleagues spoke about the middle income trap and all that. Without going beyond now the first stage of technology development, yes, we need to continue to assimilate technology, get it from abroad. But if we are really talking of overcoming the middle income trap, then we need to get into the technology development part of the cycle, which is happening only in very few sectors, like say pharmaceuticals to some extent, but really not happening. Our R&D to GDP ratio is, by far the lowest of any aspiring country in the world, maybe 25% of East Asian countries and China and so on. So I'll stop here.
Subhomoy, can I just add, please, if that's okay with you? I'm sorry, I might be stepping out of. Is that good with you? Okay, I think you're on mute.
Sorry, my thing got muted. Please, Pooja.
Yeah, if I can just add, 2-3 points, very valuable points that Rajeshwari and Dr. Sanjay brought to the forefront. One, Rajeshwari mentioned about private investment, right? So if you go back and even look at it, private investment, so technically they're saying that private investment has increased 66% since pre-2023 levels, but where is that money going? And if you go back and see private investment, about $29 billion has moved out of the country. So a big question mark is, why are our industrialists not investing in the country per se? Where is it that we are not getting it right? One was that. Second, Dr. Kathuria also mentioned labor force participation rate, and he mentioned female labor force participation rate, right? Which I'm totally for it, because even if we increase our female labor force participation rate, what are the kind of jobs actually that our females are contributing to? Are those the high paid jobs, or are they more towards the care economy kind of a thing? Because obviously, end of the day, higher income, per capita income, is only going to be able to help us close that gap with the advanced nations. So while we are looking at increased female labor force participation rate, exactly what Dr. Kathuria mentioned, education and health are the two sectors, obviously, that the government and all of us, even us as an academician, we need to go back and look at very closely, right? And this discussion has been happening for years now, that even between academia, and I'd raise my hand for that, effectively, once the student moves out, right, and gets into the industry, are those skill sets matching as per what the industry needs or doesn't need? While the government has been talking of vocational training institutes where they'll be able to bridge that gap, but somewhere industry and academia needs to work more closely on that account also. And these are things which we can't let them go out of our focus. So that's what I wanted to add. I'm sorry. Yeah.
No, that's very well made point. I'll just shift the employment point to something, another aspect of the economy. And you had brought in the issue about, again, so it's related to employment, but it's about the urbanization and the scale of urbanization and the quality of the urbanization. And you talked about this issue about productivity per worker. How do you think, I'm particularly interested in understanding what are the instruments that a budget could be deploying to look at something like a productivity for a worker? Because that also again goes on to the quality of the employment that comes along.
Yeah.
So would you just elaborate that?
Yeah, and simple, the basic to go back to is like Dr. Sanjay Kathuria mentioned, education, right? Education, health. If we go back and look at education and health, so, and he also mentioned the fact that health, obviously productivity for a worker, if you're going to have people, falling ill too much, the productivity for worker per worker automatically starts going down. So one is health. While yes, the needle has been moving on that, but still we need to go back and put more funds both for education and health per se. When we're looking at education also, so okay, maybe our metro cities, maybe the tier 3, tier 2 cities, still the education part, we might be doing maybe a close to decent job, but then why we say, okay, right to education for everybody, but the question mark is on what kind of education is actually happening as far as our villages, etc., are concerned, right? So if I were to look at productivity per worker, two things, first and foremost, which will probably go back and set this right, is that we focus on improving our education and improving the healthcare facilities, which in the long run will hopefully give us the returns that we're looking for.
Yeah, that's interesting. At this stage, especially the young people who are listening into this very interesting discussion that's going on, I'd suggest that you look at some of the budget documents. The reason I say so is the budget also carries something called an outcome budget. And for instance, data that I had seen in that outcome budget, I tracked that fairly closely, and it'll be interesting for you. I read it off from there that the number of students who will be offered apprenticeship in FY 26-27 will be 6 lakh. That's interesting. But the other data corresponding with that, again from the budget document, is the students who would acquire practical industry-specific skills and will be judged as good and above by the industry. So industries will acquire practical industry-specific skills and will be judged as good and above by the industry. And the government expects not more than 40% of those apprentices will have that rating. Now, that is a very interesting data that comes around from the budget document. That what is it that the government itself feels will not be working. Similarly, if you look at the children enrolled in vocational courses and about what percentage of them will be moving into those courses, the government expects not more than 12% of the total enrollment. Now, these are fascinating numbers. It just shows across India that our education sector, and just as rightly as all the panelists have pointed out, there is a major missing link that's happening in terms of bringing up trained workers for the industry and workers who therefore contribute to productively to what the industry would need. But again,
One additional point here. I think very quickly, another the force that's going to hit us, and it probably won't hit us as bad as we are expecting, but it still will, is artificial intelligence. So it's one about creating jobs for those who don't have skills, but it's about those with skills losing jobs. And then what's going to absorb them? That's another thing that's going to hit us. And I can only hope that it's not going to be as bad as some people are predicting. But I think compared to many other countries, India will be hit much harder because we already have a backlog of millions of people who don't have jobs. So that is where I think the jobs problem just looks even worse when I think about what's going to happen over the next 5 years. Because when I teach at IGITR, my students are not getting jobs. And these are well educated, highly skilled youth with aspirations. If they don't get jobs because they are in the analytics industry where the coding and the programming and the modeling is being done by AI, then what are the chances of the vast majority of young Indians who don't even have skills other than being gig economy workers? So I think the job debate needs to be fair and center in any kind of budget or government document or speech. But for whatever reason, it's not happening at the scale that it should be. I think it's a crisis, but we are not giving it that name.
And I think
I have
this,
something to say on
yeah.
that, but I'll just bring in Yuvika at this point. Yuvika, stretching away slightly differently, the RBI came up with its monetary policy this week, and it looked at the growth projections and the inflation, and inflation at 2.1, which means the nominal growth will be at 7.6, 7.4. That means it's going to undershoot the government's 10% growth projection. What's your take on it?
So rightly said, while RBI did up the FY 26 CPI number by just 10 basis points to 2.1, But if you look at their FY27 forecast, and they have just laid out numbers for Q1 and Q2. So in their commentary, they have refrained from going out to give full year numbers for growth and inflation, both for FY27, largely because there's an impending revision to both the GDP and CPI series. But nevertheless, if we look at just the first 2 quarter forecast, that is somewhere closer to 4% for inflation. And in our own estimate as well, inflation next year is going to be substantially higher than the number that we saw this year, and very low, close to zero readings for a couple of months. So for next year, we are projecting CPI at almost at about 4%, just at 3.9. And even WPI will look substantially higher from deflation numbers that we saw last year to close to about 3.5. So what this essentially means, the combination of CPI and WPI, whichever way the government combines the two to arrive at a deflator, will be much higher than what the market is expecting at this point in time. Now, let's look at why we are looking at a higher CPI number. Obviously, there's a favorable statistical base that is at play. On top of that, food, which was depressing CPI last year, is going to bounce back this year. We are not going to see as benign readings as we saw last year, because remember, last year, a lot of the deflation in food prices was driven by the previous year, where the prices of tomatoes, etc., had really shot up. So we do not see that happening yet again, and the base will also be not in favor. On top of that, we have seen a rally in some of the commodity prices, gold, silver being the classic case, but even base metals have now risen. But then, it ultimately is a lot of black box at this point in time, while we are assuming that inflation would move higher. But remember, there's a new CPI series with a revised base. The subcategories of inflation are going to look very different from the previous year. And as we understand at this point in time, the NSO is not releasing any back series to CPI. So we'll really have no comparison between the old series and new. And anyways, they are so dramatically different, the old series and new, that it would be akin to comparing apples to oranges, even if you want to do so. But having said so, the moot point being that inflation will look higher. Our real growth will be somewhere close to 7%. The uncertainty related to the India-US trade deal is probably behind us. So that should offer some upside to growth, because that was one tentative or uncertain factor that was weighing on our growth projections or growth implications for next year. So keeping in mind a 7% real GDP growth and closer to 3.5-4% average for CPI and WPI put together, we are probably going to look at a number of nominal GDP close to about 10 to 11%. And I think that's where the budget, the government's projection of 10% nominal GDP growth is actually a tad conservative in our opinion at this point in time. But then everything comes with a caveat. Let's wait and watch and see what the new series ultimately announce for us to go back to the drawing board to see if there is any kind of tinkering that we need to do in terms of our projections.
Which brings me to the next point that, as you rightly pointed out, that the inflation trajectory would swing upwards. And the numbers that you're talking about, from about less than 1 to so going up to something like above 3.5, closer to 5, even if not touching 4, is quite a bit of a swing in the middle of a year. And yes, RBI would be expecting, I suspect, from what from their way they have laid out the projections, is that will probably be the third quarter, which does one advantage would be that raises rural income, because if the inflation rises, but at the same time, it does create a pressure of a swing which we have not seen for several years in the price levels. Even though, of course, there are base effects which are changing some of the numbers, but do you think, or do you have any reasons to feel concerned that the pace of the upward movement might be a tad faster than what should be there, especially in a year when there's quite a few imponderables globally?
Well, I don't think 4%, definitely higher than last year, but it doesn't raise any red flags. It's still closer to the midpoint of RBI's inflation targeting band between 2 and 6%. And mind you, like I said, there are a couple of forces which are at play this year. Even if we assume that things remain in a status quo mode, just the base effect is going to catapult next year's inflation higher. So that would take care of a large part of the upside that we are already building in. And then on top of that, global uncertainties, commodity prices, we've already seen 5% to 6% depreciation in the rupee. That would also add to your imported inflation with the lag, right? You are importing a lot of inputs that ultimately will get captured on both your WPI and CPI with the lag. So a lot of dynamic factors that are at play here. Keeping in mind those along with the statistical base, I would say 4% looks higher, but nothing to be worried about.
Right. At this point, the one aspect that we hadn't touched, and of course, I was wondering whether we should be, it is the impact of the 16th Finance Commission. Now, the devolution of money between the center and the states becomes very significant, especially because many of the things that our panelists have flagged, issues regarding employment, issues regarding, as Rajeswari is pointing out, issues regarding even providing a sort of a support mechanism for the people who are unemployed, or even building up capacity within the states for health and education. The 16th Finance Commission has more or less kept the basket at 41%. What's the stake of this panel? I'll go by Yuvika. You start off and then I'll go along on that way.
Honestly speaking, my forte is not in looking at the 16th Finance Commission, focuses more on markets. But I believe that the budget, from what we have understood, the devolution remains largely in line. And I think from a perspective of the state and the center devolution, a lot changes because of the changes that we have seen in forms of the GST restructuring.
Yeah, what I was asking you, because that whether does it create a mechanism or does it incentivize the states to hit the markets in terms of the fact that many of them are now will be asked to reduce their debt GDP. That's something that's definitely something that the markets would want to read from the states.
Yes, so I think it plays in both ways, that they have the compulsion to reduce the debt to GDP ratio, but also remember states have seen a lot of fiscal profligacy over the last few years. We have seen a lot of schemes which are, cash oriented in nature, which have been announced in the run up to the state elections in several states. And that's put a fair degree of burden on the states' fiscal numbers. Besides that, if you look at the own tax revenues of the state, and given the entire GST restructuring that was announced, that doesn't offer a lot of comfort to states in terms of garnering revenues from either the center or leveraging their own tax revenue sources. So what this essentially means is that the fiscal numbers from the state do not offer a lot of confidence, and they'll have to go back to the market to raise a large chunk of their government borrowings. And that essentially means, and that's already baked into the market estimates, that yet again it will be a year when you'll see humongous amount of state borrowings hitting the market. And how do you eventually take into board these borrowings, which are going to increase year after year? The REVEX commitments of neither the state or the center are going to correct dramatically. And remember, we have the 8th pay commission also that the center is going to announce in FY28. And typically the states also follow suit with the pay commissions in their respective states in a gap of a year or two. So then essentially, where does the money come from? You can't have indefinite borrowings both from the center and the state. And really, that's where the policy thinking needs to move, that how do we credibly either reduce the debt, add more credibility to the fiscal numbers, especially at the state, because there's a lot of focus on the center. But what about the states? What are individual states doing? And how is their fiscal arithmetic panning out? And in totality, like I said, how does the bond market clear? Because your obligations are not going to reduce overnight.
So that's something that because we do spend a lot of time looking at the central government things, but the state finances is, I think, something which is very important to look at. In that context, since Rajeswari Sengupta, you've got a hard stop at 8, I just want to bring you in quickly that what would you say, given the central budget focus, what should be some of the things, priorities that the state should be taking up vis-a-vis the projects and the fiscal space that they have?
So, couple of points here. One is, I think the 16th Finance Commission's hands were slightly tied because the government's fiscal deficit projection is 3.5% of GDP in the next 3 to 4 years. So, if you have to do the glide path to 3.5% of GDP, you cannot do a devolution of more than 41%. So then if you do backward calculation, this is basically where it remains stuck. Also, you have to understand that the divisible pool is shrinking because of higher proportion of cess and surcharge. And that actually, the 41% devolution prevents a revenue shock, so to speak, because any increase in devolution would have been problematic given the cess and surcharge has become such a big part of the overall revenue pool. Which brings me to the point of the states, because their persistent complaint has been they don't get any part of the increasing cess and surcharge, right? So it's sort of become a bit of an unfair allocation in some sense, that the government is getting a lot through this kind of avenues, which is not really passed on to the states. And then the states are then forced to borrow from the market, but then that again goes to, they have a certain borrowing limit from the bond market as well. The third point I would like to make is that in this budget, the government did capex push, but much of the capex push is actually going to the states because they increased that interest-free loan to the states by 15%, which means they announced capex, but the expectation is that the implementation will be done by the states. The problem is many of the states, particularly in the eastern part of the country, don't have the capacity to implement big infrastructure projects. And much of the states are actually using money to do freebies, exactly as Yuvika mentioned, to do pre-election gaming of the system. So I think pushing that capex mantle to the state was not particularly a very good idea, because I don't think many of the states have the capacity to do these infrastructure projects. They haven't been doing it for the last 10 odd years, so to speak. You look at power plants and whatever it is that you look at, they're all in very shoddy state. And then on the other hand, the government's own fiscal constraint that you couldn't have increased the fiscal devolution, but maybe some rationalization of the cess and surcharge could have happened so that it doesn't seem very unfair as far as the states are concerned. That's where I'll stop.
That's very interesting, Dr. Kathuria. Export-led strategy. I mean, states. This is something where again I mean, after all, there are wide differences now developing among the states in terms of their capacity. So, I mean, how do you analyze what the states should be doing to push the envelope?
See, at the end, the market goes, the most efficient form of economic activity is clustering, right? Urbanization, that's the way, as Pooja was also saying, and we've had World Development Reports in the World Bank about these issues, so about economic geography and the natural way that you have formation of economic clusters. So I think it's great to have initiatives at the state level and all of that to try to promote. But rather than promote new things, I think the economists are not very good in analyzing how to create something completely new out of the blue. But we are much better at suggesting when a cluster already exists, how to improve upon that, how to make it more dense and more successful, right? But how to create say, an automotive cluster in, let's say, in Uttar Pradesh, for example, that we have no clue about how to do that. But if you want to say an automotive cluster near Indore or near Chennai, which already exists, right? Or near Pune, yes, then there can be lots of suggestions there about how to do improvement, improve facilitation for those kinds of clusters. And so these schemes for district level exports and all that, I think they should focus on the strengths that already exist, right? So Moradabad handicrafts, carpets from Mirzapur and Bhadoi and all of that. So focus on what you already have rather than, otherwise we will risk, again, dissipating our energies and with the results which could be very questionable and dubious, right? If I may, I will just take a second on just the 16th Finance Commission.
Please do.
I think it did some interesting things at the margin. So it is giving now, we've heard a lot about these issues about southern states and 4 or 5 states contributing more than what they receive in return, including some of the primarily southern states, but not only. There are a couple of others as well, right? So the 16th Finance Commission is creating a better incentive structure, that they're giving some incentives for for performance, the contribution of the state to total GDP, right? Earlier there was no. So there's a little bit of performance. I believe it is up to 10%, the transfers will take into account the contribution of the state to GDP, in addition to population, etc., which was the concern that states are poorer, but they have larger populations, therefore they get more. So that was a disincentive. So this is creating some of that, correcting a little bit of that incentive issue for higher performing states. The other one I want to flag, which is promising, is the greater devolution to local bodies, right? And I think that's very interesting because local bodies need to, they need to fix our cities, our, urban, our cities are in a complete mess, right? We know that every rainy season we see the evidence of that. So more devolution, I believe there's an increase of 130% for urban local bodies, for example, but overall some more autonomy and some more devolution to local bodies. I think that is welcome, and I hope that these are followed through in terms of implementation. And I know that the budget has accepted everything of the 16th Finance Commission in the statement that it put out. So that's good.
Yeah, it's also constitutional propriety. I mean, the finance minister, because after all, it's approved by the cabinet, and so the finance minister doesn't have any room to disagree with any award by the commission. It's a constitutional award, so there has to be. But your point about the local bodies being looked at opens up another issue, which I don't think we'll have the time to look at today, but that also ties in with what Professor Misra was talking about the urban development. And so, Professor Misra.
Yeah, okay. So
I'm
just
sorry,
to add to that.
I'll just drop off. I'm really sorry.
Sure, please.
Thank
Right.
you so much. Thank
you. Thank you.
Okay, just to add to that, I completely agree with what Dr. Sanjay Kathuria and Rajeswari said, right? So if you were even to ask me the VBG Ramji scheme, okay, right? If you so this time at least they made changes to that the money will go to the states which are really in need of it instead of all states getting the same amount of money kind of a thing. So we are moving in the right direction. And okay, interestingly, today, so when I was watching the news, one of the channels said that as far as our mayors are concerned, municipal authority mayors are concerned, right? They're all probably, so disclaimer attached to it, but they're all probably just in, a rubber stamp kind of a position.
You don't need to have a disclaimer. They're just rubber stamps. I mean,
Yeah.
there's no mayor in India who compares with the New York mayor or anything. And our
True.
mayors don't even have even the power to sign a T for themselves.
True. So I think they need to take more, yep, and they want to take more, they need to take much more responsibility, in all these local bodies need to take much, much more responsibility per se. It's interesting over the past so many years, at least now states are competing with each other to attract the money from abroad also, FDI into their states. So we're in the right direction. And states necessarily should not be looking only towards the center for money. Plus, like everybody mentions, welfare schemes start bringing down the expenditure that you're doing for your welfare schemes and manage your finances better. So I'm totally in line with that entire thought process. So if it's okay, can I also log out? I need to
in case we are also at the end of the time, and I'll on this note, I mean the panelists have summed up their points of view so well that I really don't want to try to summarize the thing, but I'll suggest one of the great things that IMPRI does is every year's budget discussion they put up, and I think it's a good thing for us also to remember what I said last year. I better be better this year. So I think that's a very good note. And from my side, I learned a lot. Thanks a lot for being with me and taking on my questions. Manvi, over to you.
Thank you, sir. Sir, but I have one question, if you may
Yeah,
permit me ask here. So, Yuvika ma'am, since I have a question from you. So, ma'am, the entire discussion was around employment, manufacturing, and how the budget is helping out. But I personally believe that now we are stepping in an era where the competition or the world markets are not only driven by cost and scale, but they are now being driven by the design, branding, creativity. And there was a mention about the orange economy as well in the budget. So, ma'am, how can we position orange economy in terms of competitiveness window that it will generate, and as well as how can we use it to capitalize a demographic dividend?
So I think this brings me, and I'll just summarize it in a minute or two because I understand we are exceeding the time. But I think and that's a takeaway also from today's panel, that while there is need to focus on industrial policy and fixing or plumbing where we need to set our policies right to ensure that our industry and within that manufacturing really caters to creating adequate number of jobs to be able to cater to the demographic dividend. But there's also a simultaneous nudge that we also need to ensure that the services economy, which has been contributing significantly to the GDP, also continues to offer support. And the amalgamation of the two needs to happen in the Indian economy, largely because we are in a global economic order where the rules of trade have changed. Countries have turned more protectionist. So you are not going to see the same pace and scale of export growth that some of the East Asian countries enjoyed in the 80s and the 90s. And that's a fact that we'll have to live with. Having said so, it's also true that manufacturing and labor-intensive sectors need priority because that's where your multiplier effect in jobs is important. But having said so, India also needs to keep itself reminded. It needs to remind itself that we are an economy which is an English-speaking dominant economy. We have focused on higher education more than our primary education. And that what means is that we have high level of skilled individuals also entering the market at a very rampant pace. And the aspirations of these individuals is much higher. So how to cater to that segment of the youth? You have to focus on services, and orange economy just being one sector, where you're focusing on animation, visualization, gaming, etc. But that's only one small sector within services that deserves attention. There's a whole host of services, right from developing data centers. And the proof of the pudding lies in how our services exports have actually ramped up over the last maybe 5 or 6 years in the post-COVID world. So earlier we were very traditional in our services exports coming in from IT only as a dominant sector. But look at the proliferation of services. We have services exports now seeing significantly being contributed by finance, legal, advertising, professional services, business consultancy. So there's a whole host of focus that services also need at this point in time. And both the industrial and the services policy needs to go hand in hand for India to become Viksit Bharat and to be able to cater to adequate jobs for the youth.
So essentially, what we are saying is that this is a Dhurandhar economy. Was the budget up to the task of addressing the challenges of this economy? Our panelists looked at it from four perspectives, very rich perspective they brought along. Manvi, it's over to you, and I hope there was an adequate food for thought. Yeah.
Thank you very much for inviting us. Thank you.
Yeah.
Thank you, ma'am, and thank you, sir. Yep. So we are deeply grateful to all our panelists for this insightful discussion, and thank you to the participants for your thoughtful, active participation. So now I would like to invite our chair to deliver the closing remarks. I think, sir, I should proceed with the vote of thanks then.
Yeah, you can.
Yeah. So, as we conclude this panel discussion on the Indian economy and Union Budget 26-27, I, Bhanvi, on behalf of IMPRI, Center for the Study of Finance and Economics, New Delhi, extend my heartfelt gratitude. Our deepest thanks to our chair and experts for today. Thank you to all our esteemed panelists for their insightful and thought-provoking addresses. Your expertise and perspectives have greatly enriched today's discussion and provided us with valuable takeaways on this critical topic. We deeply appreciate your time and contributions. We also thank all participants who joined us live, raised questions, and contributed to today's dialogue. For those watching later on YouTube channel, listening to the podcast, or reading a publication, value your engagement and interest. We look forward to welcoming you all to our next Union Budget discussion tomorrow at 10:30 a.m. on Education, Science and Tech, Research and Development, and Union Budget 26-27. We hope you will continue to join us for future IMPRI, #Web Policy Talk, and Web Policy Learning programs. Wishing you all a wonderful evening. Thank you.
Thank you.
Thank you.
Have a good
Thank
day.
you.